My targets are 7,000 gold and $200 silver. Now, why? So I think $7,000 gold, if you look at the technicals, if you look at history, I think 7,000 absolutely is a very achievable level. And I actually think we probably will go significantly north of that. But I think that's a very conservative target. I mean, we were just at 5,600. So 6,000 is just way too low, right? So I think 7,000 is a legitimate number right now. Now, if you use 1% of gold, that takes you to $70 silver. Well, that's way too low. 1% is just ridiculous. We were at 3.5 in 2011. So if you go 2%, it's 140. And if you do 3%, it's 210. So I think it'll be somewhere between 2 and 3, and it could go to 4, which would be 280.
Gold and silver prices are rising. Both technical and historical trends indicate further gains ahead. Recent highs around $5,600 show the market is far from finished moving up. Expanding monetary factors and tightening supply are pushing prices higher. Durrett, known for his focus on mining equities and valuation metrics, explains that a $7,000 gold target is not extreme, but rather a conservative estimate based on past cycles and current momentum. Using percentage relationships between gold and silver, he highlights that even modest ratios of 2 to 3% would place silver between $140 and $210, with potential for higher levels if the cycle accelerates further. Historical peaks support this framework, suggesting that silver could outperform gold in percentage terms. This means silver has more leverage in the cycle. As gold rises, silver usually moves more, increasing gains when markets are strong. Now, we present the clips from Durrett's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Gold is very easy to understand. 80% of gold is investing gold or jewelry, which is basically the same thing. And so gold's really easy to understand. It's just an asset, it's a store of value asset into story. Simple story to understand. Silver is, I consider gold a man. It's ruled by the sun. It's very masculine. It's very stable. Leo is the astrological sign that ruled by the sun as well. It's also ruled by gold. Gold is the stable masculine sign. Silver is the feminine sign. It's ruled by the moon. The moon is always the maternal moon. It's always the feminine. You can't understand silver. It's very volatile. And when you buy, you just don't know what's going to happen with silver. Silver right now, gold's down 16%. This is the thing that cracks me up, how you can't understand silver. Gold's down is 16% away from its all-time high. Guess, I'm going to let you guess because you won't even come close. You might get it. Guess what the percentage is that gold has to rise to get back to its all-time high. Gold only has to go up 16. So what do you think silver has to do? It's at 79 right now. Call it 80. It's got to go to 120. It's got to rise 50% to get back to its all-time high. That's how volatile silver can be. So silver, you can't understand it. We don't know it up and down. When it runs, it really runs, right? It went from 35 to 65 in a few months, over 100% move. So silver, we don't understand. Silver has so many issues, if you will. One, not only is it an industrial metal that needs about 70% of its supply needs to be done by fabricators, but it's also a critical mineral. I mean, gold isn't even close to a critical mineral, right? Silver's a critical mineral. And there's not enough of it. If you look at above ground supplies, as a matter of fact, right now, the COMEX has like 80 million ounces in registered. 80 million. I mean, they're running out real fast. They're going to have to come up with some silver here this year. They're going to run out. I mean, if you look at the inventory levels, the LBMA and the Shanghai, those are the only three places where you can buy silver. And right now, over 200 million ounces a year is needed just for solar alone. And if you look at vehicles on top of that, you get to 300 million. All the vehicles, including airplanes, anything with a wheel on it basically needs silver. Anything, all your appliances, all your phones, they all use silver. So it's easy so we could run out of silver. Okay, if we run out of silver, then what? We don't know. It's uncertainty, right? What does the government do? Do they prevent us from buying silver? Do they tax it? What do they do? We don't know. There's lots of uncertainty around silver. And so in theory, silver should just absolutely go to the moon in theory, because there's not enough of it. And if gold goes higher, silver's going to follow, which I've been saying. I'm confident that silver will follow gold, but there will be periods. This is important. There will be periods when silver does stuff that we just shake our head and go, what the hell's going on? And what I mean that is that like silver could go to 150, 180, and then turn around and go all the way back down to $80 and stay there for 3 months. I mean, we can see crazy stuff like that. Now, why would silver do that? It would be because the government put some regulations on. But anything that the government does will be a one and done thing. They won't be able to do it permanently because it's global. It's global in nature. So anything like the West does, they can't put that pressure on China and India. China and India, they're going to keep buying silver, period. But the U.S. can try to control the inventory levels. One of the things I think the low-hanging fruit is they can empty the ETFs. And that's an easy one, but it's a one and done thing. Once they do it, then once that inventory is gone, then they can't do it a second time. And so people will, in many that's what I meant. They could push it to 80 for a few months, and then it would start going. Then it would start trending back, and then it would rip back to where it was at before. So you'd have to just be patient and wait for it to come back. But if you own silver miners, your silver miners could drop 50% in a week, and a lot of people can't handle that volatility. So the volatility in the miners is going to be silver is going to be very extreme. But ultimately, it's going to go much higher. The key here is gold. Gold, it's how long this bull market, does it last 2 years, 3 years, 4 years? We don't know. I think it'll last at least 2 more years. And the longer that the bull market and gold lasts, the better for silver. It's very basic, very simple. So my targets are 7,000 gold and $200 silver. Now, why? So I think $7,000 gold, if you look at the technicals, if you look at history, I think 7,000 absolutely is a very achievable level. And I actually think we probably will go significantly north of that. But I think that's a very conservative target. I mean, we were just at 5,600. So 6,000 is just way too low, right? So I think 7,000 is a legitimate number right now. Now, if you use 1% of gold, that takes you to $70 silver. Well, that's way too low. 1% is just ridiculous. We were at 3.5 in 2011. So if you go 2%, it's 140. And if you do 3%, it's 210. So I think it'll be somewhere between 2 and 3. And it could go to 4, which would be 280. But I think it'll be somewhere between 170 and 200 is kind of where I think it'll go. But it'll probably overshoot that and then come back down in that range. And then we could see periods of significant corrections that are much, much lower than those levels. I think it'll stay above 1%, but definitely. So that's kind of where I'm at with silver, a kind of a $200 target. I plan to sell all my miners somewhere between $6,800 gold and $7,800 gold. I do not expect to own any miners at $8,000 gold. And the reason why is 2 reasons. One, I got in early so I can leave early. And the second one is you don't want to sell tops. You don't want to wait for tops because you just don't know when they're going to come. And when they come fast and furious. So, at $7,200, $7,300 gold, I'll have sold probably half of my stuff. Again, I'm a speculator. When I say the Lahontan is going to go to $5, that's at $7,000 gold. Now, most people are like, Don, you're absolutely nuts. We're not going to $7,000 gold. Maybe we won't, but I can speculate that we are, and that's what I do. I'm just going to, it's basically gambling. I'm going to gamble that gold goes to 7,000. So if it does, then these type of returns are kind of there. That's why I say there's like 10 baggers all over the place. That's at $7,000 gold and $200 silver. I really don't care about the current gold and silver price. I look at a company's current market cap and I compare it to their estimated future market cap.
Gold is easier to understand, mainly serving as a store of value. Silver is less predictable because it is both a monetary and an industrial metal. This makes silver much more volatile, often requiring bigger moves to reach old highs. Gold is near its previous peaks, but silver still needs a big rally, which could lead to larger gains. At the same time, supply limits are obvious. Industrial demand from solar, electronics, and transport is rising. Above-ground inventories are low. Major exchanges have fewer reserves, and growing deficits mean tighter supply. This could increase price swings as supply lags behind demand. The market will likely see high volatility and upward trends. Silver could swing sharply, but should rise with gold. Let's get back to the interview.
My newsletter that came out in January 1st, I said that this is the last year of American greatness and that I expected a recession this year. But I also said I expected in the second half of the year. So here we are in April, and it's hanging in there. It doesn't look like we're going to have a recession in the first half of the year. But I think it will happen in the second half of the year. And the reason why is because of the midterms. I just feel that the optimism in America, if you will, one of the reasons why we have this optimism is Trump is a pro-business president. He's kind of a low tax, low regulation, I'm going to do whatever it takes to grow the economy attitude. His focus is on the economy. And that has supported the stock market substantially. Well, he's going to be a lame duck if the Democrats win the House in November. And I think there's a very good chance that is going to be the outcome. And so if he loses the House and he becomes a lame duck, at that point, I think business is going to start to get really, really nervous about how late in the cycle we are, how close we are to recession, and then now what? How are we going to avoid this? For instance, if you look at the corporate tax rate, and if you look at the highest rate for consumer individual, I think it's 37% is the highest rate, and then capital gains, 15 and 20. Is very low. And so those three rates, the Democrats are going to raise all three of them if they get an opportunity to do it. And so I think that we're going to start to recognize that the economy is slowing and the Democrats are basically not going to be very helpful in that regard. They're not going to be a pro-business stance at all. They're going to be an anti-business stance. Raise taxes, and that's kind of a hopium way because it's basically saying that if we raise taxes, it won't hurt the economy, but it'll help the budget. So we're basically going to be this massive deficit. Well, how do we fix the deficit? Well, we're not going to cut spending. We're going to raise taxes, and so I think that people are going to start to see that the direction is towards higher taxes and not lower taxes. That we're in a low tax. This is as low as taxes are going to get. And they're just going to go higher from here. And I think a lot of confidence is going to be sucked out of the economy between now and the midterms. And once the midterms, I don't know if the crash in the stock market will happen before the midterms or after. Flip a coin there. But I do think the second half of this year, I'm expecting the recession and the stock market to go down. So for me, I think 5,500 is where we basically get a decoupling. So gold and the S&P 500 have been basically, I think, in this battle of who's going to win. They're both basically near all-time highs, although gold's 16% from its all-time high, about 4,850, and its all-time high is 5,600. So it's about 16% away, and the stock market's only 1% away. But every time, in the last 2 years, every time gold corrected, it turned around and ripped back for an all-time high, which I think it'll do again. So they're in this battle of who's going to win, who's the winner. Normally, they don't both win. Normally, one does well and the other does poorly. They're cats and dogs. They do not get along. And so which one's going to be the winner? And I think that at 5,500 is the numbers where that's where the battle is going to be fought. So it's going to be 5,500 on the S&P, and we're at 6,900 today, 68, almost 6,900. So it's got a long ways to go all the way down to 5,500. And gold, I think 5,500 on gold, though that's where you're going to get the decoupling. So when they're both right around 5,500, now we probably are going to see 5,800 on the S&P and 5,000 on gold. So gold will be down in about 600, and then gold will start rallying, and right at 5,500, that's where they'll crisscross. So gold's going to go below 5,500. It already is at 48, but it'll be below 5,500 when this decoupling starts, and the stock market will be above it, and the stock market will go below 55, and gold will go above it. But that's just my kind of line in the sand. That's what I'm looking at as the place where the battle is won by gold is right around 5,500 on the S&P, and I think it'll happen this year. I think gold will hit an all-time high, possibly in June, and then have another deep correction all the way down to, we might even go all the way back to 4,100, but 4,100 looks like it probably will hold unless the Iran war gets worse. If it gets worse, then we might go back below it. Right now, it looks like 4,100 is going to be the low, but I think we'll go back down to 42 to 4,400. Even if we hit an all-time high, if we go to 5,600 again, I think we could crash all the way back down to sub 4,500. One more deep correction. But the one thing people need to realize is that gold is the asset to own. It's the buy the dip asset. It's going higher. So I don't care how much they try to push this thing down. They just tried to push it to 4,100. 4,100 like 2 weeks ago, right? We're at 4,850. It went up $750 in a week. So good luck holding gold down. It's not going to happen. That's why I say you want to buy these dips, because gold is the buy the dip asset. The only way that gold's going to get pushed down and held down and kept down is if the U.S. economy comes roaring back to life. And I just gave you that long list of problems that we have to fix. I mean, good luck with that.
The macro outlook suggests a turning point, with economic confidence likely to weaken as the year progresses, particularly if policy uncertainty and fiscal pressures intensify. Equity markets have remained resilient, supported by pro-growth sentiment, but underlying risks tied to rising debt, slowing growth, and potential policy shifts continue to build. As these pressures surface, the balance between financial assets and hard assets is likely to shift more decisively. Gold is positioned to gain from this change, especially if there is a slowdown later in the year. Stocks and gold are nearing a point where they could move in opposite directions as investors seek safety. History shows precious metals often outperform when this happens. As uncertainty rises, gold's value as a safe haven grows. This supports a long-term price rise despite corrections. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.